Did you know Warren Buffett, the Oracle of Omaha, has led Berkshire Hathaway to an average annual return of 19.8% from 1965 to 2023, far surpassing the S&P 500's 9.9% in the same period? These numbers come directly from Berkshire Hathaway's official annual reports. And now, Buffett has issued a striking warning. It's time. Time for what exactly? Stick around, because by the end of this video, you'll discover the exact warning Buffett is sharing, and more importantly, how you can safeguard your finances against what's coming. Did you know that Buffett's portfolio has been shifting quietly over the last year? Stocks he once swore by, like Coca-Cola and American Express, are holding steady. But the real story is in the stocks he's been reducing, or even abandoning. Take, for example, tech stocks. Buffett famously avoided tech companies for years, but recently invested heavily in Apple. Rumor has it that Berkshire Hathaway is considering reducing its stake. Buffett always says about investing, be fearful when others are greedy, and greedy when others are fearful. So the real question is, who's being greedy right now, and what's he afraid of? It's not only his portfolio, though. It's something far more significant. This move may have an impact on all markets. There have been ups, downs, and everything in between in the stock market lately. News headlines that have the potential to either wow or frighten investors appear on a daily basis. Buffett has raised some serious red flags about market volatility. He's not just talking about a few bumps. He's suggesting that we might be entering a period of significant uncertainty. Buffett worries about the growth of risky activity in the market, citing cryptocurrency crazes and meme stocks as examples. This is when things start to get interesting. Did you know that Buffett currently has an astounding $325 billion in cash on hand? Yes, cash makes up 28% of Berkshire Hathaway's total assets. Buffett is a strong admirer of being ready for opportunities when they arise. Keeping cash on hand allows him to make cash from cheap stocks, while others may be in fear, since he is aware that markets may change quickly. Imagine this. If a major market correction happens tomorrow, most investors will love having cash ready to scoop up bargains. Buffett has consistently stressed the value of keeping a sizable cash reserve, a safety net for unforeseen circumstances, in the past. Do you recall the dot-com craze of the late 1990s? Buffett steadily increased his cash reserves as everyone else hurried to buy overpriced tech stocks. He was able to purchase premium companies at heavy discounts during the market meltdown. Fast forward to 2008, while others were forced to sell at rock-bottom prices during the financial crisis, Buffett's cash pile allowed him to make some of his most profitable investments ever. He made billions of dollars in earnings via agreements he made with Bank of America and Goldman Sachs. He is still using this same tactic now, but on a far larger scale. Not only have his monetary reserves increased, but they have skyrocketed. One thing is evident from these figures. Buffett is preparing for something catastrophic. One of Buffett's favorite sectors has always been utilities, companies that provide essential services like electricity and water. And you know what? He's going all out for them. Because folks still have to pay their utility bills when things get hard. However, there is more. Buffett now owns a larger portion of energy firms. By switching from conventional oil and gas to renewable energy, he is setting himself up for a future in which energy will rule the world. And Buffett's not just betting on big corporations. He's investing in infrastructure, the backbone of the economy, roads, railways, and even pipelines. It's almost as if he's preparing for a world where tangible, essential assets become more valuable than flashy tech stocks. Let's now discuss something that rocked Wall Street: the fact that Buffett began selling Apple stock. For good cause, this maneuver attracted everyone's attention. To appreciate the significance of this, keep in mind that Buffett's passion for Apple started in 2016. Since then, Apple has become one of Berkshire's crown jewels. At its peak, Buffett's stake reached an astounding $178 billion. But something dramatic has changed recently. Buffett sold nearly 10% of his Apple position in the last quarter alone. This means Berkshire's holding dropped from 400 million shares to approximately 300 million. This is a radical change from an investor who famously said that his preferred holding term is forever. It's not simply another standard portfolio tweak. Taxes and value issues are the two main considerations that determine the answer. Let's start by discussing value. Buffett has been outspoken about how difficult it is to locate assets at fair prices in the current market scenario. He probably believes that keeping such a large role will become less valuable as Apple reaches new heights. Next is the tax angle. He could decide to sell now as talks about possible capital gains and tax rises intensify. Particularly in light of the current state of the U.S. debt, he could avoid even bigger tax obligations later on by lowering his shareholding. When Warren Buffett started reducing his position in what he once called one of his best investments ever, it sent a powerful message about broader market conditions. Let's have a look at another important flag of Buffett's warning, the Buffett indicator. This easy but useful indicator shows the GDP of the United States with the entire value of the stock market. This indicator is now generating warning signals. At the moment, it stands at an astounding 208%. To put this into view, it only reached a concerning 140% during the 2000 dot-com boom. It reached almost 110% even during the 2008 financial crisis and recession. Today's reading doesn't just surpass these previous danger zones, it absolutely dwarfs them. When the total market value is more than double the size of the U.S. economy, there is a substantial mismatch between stock prices and real economic activity. Imagine a tree whose branches are becoming far bigger in size than its base can sustain. Something must give at some point. It is easier to see why Buffett has acted so defensively in his portfolio in light of this extraordinary understanding. He's seen these numbers climb before during past crises, and both times his caution was validated by subsequent market crashes. When someone with Buffett's track record starts taking defensive actions at levels we've never seen before, it's definitely worth paying attention. As if worries over market prices weren't enough, Warren Buffett is now monitoring the U.S. debt-to-GDP ratio, another important indicator. This ratio, which is now above 120%, indicates that America owes more than it generates in a single year. However, as the amount of government debt increases, financial strains are created that affect every aspect of the economy. First of all, as debt accumulates, higher borrowing costs are unavoidable. To entice investors to purchase its bonds, the government will have to raise interest rates. These higher rates don't just affect government spending, they create ripples that touch everything from corporate profits to consumer spending. We're witnessing historic debt levels at the same time as market valuations are hitting all-time highs and interest rates are climbing sharply. It feels like three pressure cookers are all reaching their limits simultaneously. When debt levels are this high, even small changes in interest rates can have massive impacts on government spending and economic stability. Each percentage point increase adds hundreds of billions to annual interest payments, money that must come from somewhere else, higher taxes, or reduced spending. This scenario tells why Buffett is really altering the way he structures Berkshire's assets rather than just reducing the size of his portfolio. He seems ready for any eventual economic situation by increasing cash reserves and lowering exposure to particular industries. Buffett's warning is further complicated by interest rates, which are currently his biggest worry. Right now, rates are at their highest point in years. This results in an environment that is essentially different from what we have seen in the last 10 years. It's not only greater borrowing expenses, though. Low interest rates were a key component of many businesses' business plans, allowing them to use inexpensive loans for growth or stock buybacks. Their bottom lines and eventually their stock prices may be severely impacted as a result of their requirement for refinances at these increased rates. To truly grasp why Warren Buffett's current moves are sending strong warning signals, we need some historical context. Throughout his 6-decade investing career, he has made defensive moves only a handful of times, and each instance preceded significant market corrections. Let's travel back together to those pivotal moments. In the late 90s, during the dot-com bubble, while most investors were swept up in tech stock frenzy, Buffett faced intense criticism for refusing participation in new economy stocks. Instead, he steadily built up cash reserves and stuck with value investing principles. Many claimed he had lost touch with modern investing. But when the bubble burst in 2000, Buffett's patience was vindicated. While tech-heavy portfolios were devastated, Berkshire's conservative positioning allowed it not only to weather, but also capitalize on opportunities emerging from the wreckage. The lesson was clear. Sometimes the best investment move is deciding not to play. Fast forward again to the 2008 financial crisis, and we see another telling example of Buffett's crisis preparation. Leading up, Berkshire accumulated a $44 billion cash reserve, a figure seen as excessive by many at the time. But when the financial system began crumbling, that cash pile transformed from drag-on returns into a powerful weapon. While others were forced into fire sale prices, Buffett struck legendary deals, including a $5 billion investment in Goldman Sachs, a move generating billions of profits while stabilizing the financial system during a critical period. Fast forward once more to the pandemic crisis in 2020, and we witnessed yet another masterclass from him. While many investors panic-bought during the initial recovery, Buffett remained notably cautious, maintaining significant cash reserves and waiting for clarity before making major moves. This patience, which seemed overly conservative at the time, now looks prescient as we face growing economic uncertainties today. His current positioning is even more defensive than during any previous crisis period. His cash reserves are substantially larger, selling activity is more pronounced, warnings more explicit than ever before. When someone with such an impressive track record takes dramatic defensive actions, it would be wise to at least understand the reasoning behind them. So what do you think about Warren Buffett's warning? Are you adjusting your investment strategy based on these insights? I want to hear from you in the comments below. And don't forget to subscribe for more content like this. We'll keep bringing you valuable insights into what top investors are doing and what it means for your portfolio. Thanks for watching, and until next time, stay smart with your investments.